Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
Our Bloomberg Opinion columnist, Andrea Felsted, she put out a column today. She said that after 3 years of rushing to book trips in the wake of the pandemic-era restrictions, sharply higher fares, protests against tourism, fatigue from endless hours spent in airports, and income squeezed by inflation, Tim, are all taking their toll.
Okay, so let's check in with Kevin Jacobs about this. He's the president and CFO over at Hilton Worldwide Holdings, home to 23 brands, including Hilton Hotels and Resorts, Waldorf Astoria, Hampton, Doubletree, Embassy Suites, and new brands like Spark by Hilton and Live Smart Studios by Hilton.
Kevin is in New York City. Kevin, great to have you here on Bloomberg Businessweek. So as I mentioned, our Bloomberg Opinion columnist writing, she says travel demand is far from falling off a cliff, but there are signs that our wanderlust is downshifting from never ending to a more normal pattern. What are you seeing? You guys see a lot firsthand. And welcome.
Yeah, first of all, Carol and Tim, thanks for having me on. We're not really seeing that. I mean, I think leisure travel has been normalizing off of kind of the boom that it had during COVID, but we're still seeing growing demand for travel. And in fact, most people expect the summer travel season to be quite strong. And, you know, business travel is coming back and group actually is leading the way, which wasn't the case during COVID, but you now have a lot of pent up demand for meetings and events that is fueling growth in our business as well. So we're still seeing trends. You know, certainly same-store sales growth is not going to be what it was last year, but it's still going to be quite strong for this year going forward.
So where are you seeing the best growth, the biggest growth? Like which portion of the hotel properties or which brands are seeing the best growth?
Well, if you I mean, so really all of the brands are seeing the best growth. The higher segments are growing better than the really lower segments at the moment. And our same-store sales outlook is 2 to 4% for the year. And we think the U.S. will be sort of at the lower end of that range. And everywhere else outside of the U.S. will kind of be at the higher end of that range. So international growth is still a bit stronger than the U.S., but still growing, you know, reasonably well, like kind of low single-digit same-store sales growth.
But you're seeing sort of the same growth, whether we're talking sort of the budget lower-end brands in the portfolio versus the high-end brands in the portfolio?
Well, in our portfolio, we don't have a lot of budget. We have a premium economy brand that you mentioned called Spark, and we're really not as distributed at the really low segments, which, you know, they've been a little bit weaker, but that's a lot of that has to do with more difficult comparables to last year because they were quite strong. And there's a little bit of an effect of that consumer sort of slowing down a little bit. But mostly across our growth is pretty consistent across the segments that we operate.
So any signs of softness? You know, we kicked off this hour talking with our international economics and policy correspondent, Michael McKee. There's a lot of economic data, including labor data, of course, throughout this week. But last week we saw, you know, some points of showing some softness when it comes to consumer spending here in the U.S. Any signs of softness? Are folks trading down at all?
We're not seeing trade down, and we're not really, again, other than the really low end of the business, which is a little bit lower than where we operate, we're really not seeing the consumer pull back. The consumer still feels, you know, really solid.
All right. We know you guys have a ton of properties, about 7,500 properties, including timeshares. I think that was at the end of last year, I think, when I was checking some of the data points. You own a small amount, you manage a bunch. The bulk, though, is franchisees. What's top of mind for your franchise? They're not franchise. That's like a grilled cheese sandwich. Franchisee owners. I'm a little hungry. What are their stress points? And again, does the growth kind of mirror or the upside mirror what you are telling us that you've already kind of shared with us?
Yeah, I mean, like you said, you know, upwards of 80% of our hotels now are franchises. Are you know, we manage a bunch of hotels, and our ownership segment is quite small, but you know, their outlook is quite good. Our construction starts, you know, so new development. First of all, we think we'll open nearly 2 hotels per day this year, right? So our prospects for growth are quite strong. Most of our franchisees are seeing the same thing we're seeing. The prospects for development are quite good. Our construction starts, so new hotels going under development was up 45% in the first quarter. We think that will continue to be up this year. And we think we'll start more rooms under construction this year than we did pre-pandemic. So I think, you know, look, it's not equal everywhere. And, you know, our franchisees are looking at prospects for revenue growth. They're thinking about their cost profile, right? Because with this great inflation that has fueled the revenue in our business, there's been cost inflation. So we're working with them to think about how to drive incremental cost savings in the hotels. But generally speaking, our owners and franchisees are quite bullish as well.
We want to talk a bit more about the cost equation, but I want to go back to that, 2 new hotels every day. You guys did come out with some news today about expanding your lifestyle portfolio, doubling it to 700 hotels within the next 4 years. How come? How and where? Like, where are you doubling? Where are you opening 2 new hotels every day?
Well, it's really across the globe. And so, we put out a press release this morning about our growth in lifestyle. We're celebrating our 10th anniversary in the lifestyle space. 50% of the lifestyle segment broadly has grown 50% over the last 5 years. And it's been double the additional hotel count in lifestyle hotels has been double that of the broader industry. So these are very popular type brands. We've been in the space for a while. We recently acquired the Graduate brand, and we entered into a joint venture with another group to bring the Nomad brand, which is a luxury lifestyle brand, into our portfolio. So we now have 6 great lifestyle brands. And we think we can go from what we have 350 lifestyle hotels today. We think we'll have 700 within the next 4 years. And the growth will really be around the world.
So, Kevin, how do you make sure that the new properties that you add, as you mentioned, 2 new hotels per day around the world, how do you make sure that the franchisees are geographically protected from competing with Hilton and other owners of Hilton when they're out there?
Well, we're pretty careful. Look, the interests are aligned, right? Virtually 100% of the capital for our growth comes from hotel and people investing in hotels, either building new hotels or buying hotels and affiliating with them in our brands. And we're invested in their success, because if they're successful, then they will choose us for their next deals, and that obviously enhances our growth rate. And so the way you do it is you're just very careful. We work with on each and every new hotel deal. We work with our partners to find the right locations for the right brands, and we want and need each of our hotels to be successful. So it's pretty self-regulating. Interests are aligned, and none of us want to put a hotel on top of another hotel where they're going to compete too much. And the reality is it's up to us to keep growing our customer base, having our brands be strong, and driving that premium performance so that our owners make more money when they invest with us. And if they make more money when they invest with us, then they'll choose us for their next deals, which enhances our growth rate.
Hey, Kevin, our Bloomberg Intelligence team of analysts noting that you guys cleared your debt maturity schedule before 2025, the majority now due in 2028 and beyond, cushioning it against sector headwinds. So it sounds like it really gives you guys really some, freedom to move around no matter what might happen in the economic environment, at least for a couple of years. Is that fair?
Yeah, I think we've always been focused on financial flexibility, right? So it's not just the ultimate quantum of our debt or the cost of our debt, which of course we care about a lot, but we're always looking for opportunities to push maturity. We have one small maturity in 2025, and then we don't have maturities for a while, and that served us well in COVID. In COVID, when our revenues went to near zero, we didn't need to amend our credit facility because we didn't have any near-term maturities. We didn't breach any covenants. And so we've always been really focused on financial flexibility as one of the core tenets of our capital allocation.
All right, 10 seconds. What's the hottest place? Where's everybody going? Real quickly.
Everywhere around the world.
Come on.
Come on.
Yeah, everywhere.
All right.
Not going to pick any favorites.
All right.
Kevin, favorite children.
Kevin Jacobs, thanks so much. President and CFO at Hilton Worldwide Holdings.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Just a bit of news in the world of commercial real estate in recent days. Common, once the largest co-living company in North America, filed for bankruptcy, and it's going to liquidate after it was squeezed by overhead costs and rising interest rates. Also, in other news, Rockefeller Center Plaza here in New York, it's what's known as a privately owned public space. It's set to get a $50 million makeover. Carol, these are just a couple of the headlines from the world of commercial real estate in recent days.
There's a lot going on. All of our listeners and viewers certainly know we like to talk about it. Let's get more on the space. Warren Haan is CEO of Acore Capital. It is one of the biggest non-bank commercial real estate lenders in the United States. The firm has offices in New York, LA, Miami, San Francisco, and Dallas. They've got about $20 billion in assets under management. Warren joining us here in studio, in our interactive broker studio. Welcome.
Thank you very much. Nice to be here.
It's great to have you here. We do like the real estate space. I hate when we say, how's it going? Because it's obviously, there's a lot of verticals to it and different areas. But look at the space. Tell us how things are going. Where's their strength? Where there's weakness?
Look, I mean, there's a lot of headlines around the negativity in commercial real estate today, and a lot of that really driven by this rapid increase in interest rates. I mean, really, when last did we see interest rates rise this rapidly? And commercial real estate is an interest rate sensitive investment.
Right.
So by virtue of that, one would conclude that there's going to be some issues. But the part that I think a lot of people are glossing over is the fact that fundamentals for commercial real estate are actually quite solid. And when I talk about fundamentals, just think about it in the context of what drives demand for a commercial real estate product, whether it's a hotel, whether it's an apartment building, whether it's an industrial complex, whether it's self-storage, and the list can go on. What are those demand generators? And when we look at it, and this is one of the reasons why I think this is, in my career, 28-year career, the most compelling time to be in commercial real estate, whether that's coming in through the credit side like Acore does, or investing in this new vintage of equity, it's really that the fundamentals remain incredibly strong. So demand is there for the product.
But the fundamentals aren't strong across different sectors of commercial real estate. I mean, we talk a lot about different classes of office buildings, for example. And what we hear over and over again from folks is, okay, well, demand is strong when it comes to Class A buildings. Yep. But at the lower end, you're not seeing demand for those.
I mean, that's true. But let's go up one level. So what drives demand? The consumer. Okay, so the consumer, particularly the higher income earners, continue to spend. And they could spend a lot. Take hotels as an example. If you take a look at the high-end sector of hotels, the average daily rate is higher than it was in 2019 by a big margin and continues to grow.
We just talked about it with the CFO of Hilton. Yeah, we
absolutely.
Just had him on.
So they're seeing that. They're also seeing expansion in the group business, meaning that the shrinking in the commercial real estate office sector is resulting in more folks wanting to go off-site to do group outings. So we've seen hospitality perform well.
Right.
So the health of the consumer, right? Particularly higher-end consumers. Secondly, corporate spending is rapid. And thirdly is government spending. In the United States, we have tremendous amount of stimulus going on through these various acts, whether it's the Infrastructure Act, the CHIPS Act, or otherwise, driving trillions of dollars back into the economy. And all of this does is it drives the demand for commercial real estate product, one way or another.
Okay, big picture. I get it, right?
Yep.
That sounds like a long-term perspective. But what's the state of play between real estate right now and banks? And I'm curious if there's still some leeway to extend and kind of wait for lower rates to happen. Because, you know, as you say, real estate very sensitive to higher rates. And so for some folks in a low-rate environment in the real estate space, no problem. Higher rates, or if they've got to rethink those loans or rework those loans, that's a whole different story. And that's when you get into either problems, defaults, and some difficult situations.
You're absolutely correct. And this is the story and the focus. Now, clearly, at the beginning of the year, there was a lot of optimism as the Fed was pivoting, effectively signaling that they were going to pivot. Resulted in a lot more transaction volume and a buildup of investment sales and optimism, buyers wanting to come in and sellers wanting to transact. With a reversal in that sort of behavior, things have slowed down, at least on the transaction volume side. But coming back to the bank issue. This is the big issue, and this is the secular change in behavior that we're seeing in the capital markets. So the regional banks made up 75% of all the commercial real estate loans in the banking sector. It's just simply math, is what I tell our investors too. The bank's cost of borrowing is significantly higher than what it was historically, whether it's through deposits or whether it's through borrowing through the Fed window or otherwise. And their assets, a lot of them are longer term assets at lower yield rates, resulting in margin compression for the banks. They have other issues too, balance sheet related issues. My belief is that we're going to see a lot more pain in that sector. You're also seeing an increased regulatory oversight of the regional banks. So and the banks are overweight commercial real estate loans. So what's happening to them is their ability to deploy new capital today is highly, highly limited. Now think of our
unless
ecosystem.
They can get it off their balance sheet.
Yeah, so there we go. So the question that I get asked a lot is, so what is the investment opportunity in commercial real estate credit? And how do you access it? Think about it as 4 waves that are going to crest at a different point in time. There's $500 billion of equity raised to invest in commercial real estate, sitting on the sideline looking to invest. Secondly, you've got $2.5 trillion of debt coming due in the next 4.5 years. That needs to get refinanced. Thirdly, you have the banks, to your point, sitting on bloated balance sheets of commercial real estate. Those loans, with the Fed keeping rates where they are and their cost of capital staying high, they're going to need to offload some of these assets. So that's the third wave. And the fourth wave is, that not many people are talking about, is with interest rates being as high as they are, there's not a lot of free cash flow available to invest in the commercial real estate properties. So from a debt perspective, the banks are going to pull back. The private lenders are going to step into the void and provide the capital for the commercial real estate sector.
But at the end of the day, your investors want a return.
Yep.
And in a higher interest rate environment, that might require a bit of patience. So I'm wondering about the patience that you guys have with real estate owners who borrowed perhaps a few years ago. Are you preparing for foreclosures?
Yeah.
As rates go up, are you working with these borrowers? What's going on?
Yeah, it's a fantastic question. Every lender is doing their best to work with their borrowers. Now, keep in mind, this wasn't a situation where borrowers were behaving badly. It's not even an oversupply issue for the most part. There's some oversupply in the sectors.
Right.
But that isn't really the driver. It was simply that you had good borrowers, you made a good loan, but when a rate cap expires and the interest rate goes from 3 to 8,
Right.
they can't afford, there's no free cash flow available.
So how patient are you?
Well, look, we try to be as patient as possible. Most of our capital is actually long-term capital. Those lenders who are going to have bigger issues are those that have leverage, short-term leverage obligations on warehouse lines and otherwise, and they're going to be less patient with borrowers.
So Warren, what's your long term? So give me an idea of what long term is. Are we talking 5 years, 10 years? Or like what is it?
Oh, for our capital?
Yeah.
It's long-term capital. It's way more than 5 years. So we could, on some assets we're taking back.
So you can ride it. Oh, you are.
We'll ride it through, and we have a very large asset management team. So we're very focused on getting out in front of the issues, working with borrowers, and then trying to get to the other side.
But will there be foreclosures, and where will they be?
There's going to be foreclosures. They're starting already. Now, clearly we talked about office quickly. That is the 800-pound gorilla. That is a secular change in demand driven by COVID. No one was expecting that. But you take a mid-office building that is a B quality, a building that was no good to go in the first place.
Yeah.
That building is going to be riddled with problems. And there are a lot of those buildings in cities like New York, Chicago, Los Angeles, and other places that are clearly having problems already. It's very difficult. There's no real simple solution there. There's adaptive reuse. You can turn them into apartment buildings.
That's tough.
Exactly. Not easy, right? And there's a bit of hope there. But there are things that lenders are going to take back that there's no real reuse. But I would say it's really isolated to office.
Is it just some office where there's going to be foreclosures? Is there other parts of the commercial real estate market where there might be some foreclosures? And forgive us, we've only got about 40 seconds.
What's going to drive it? So remember we talked about fundamentals besides office, right? And you nailed it too, Tim, and talking specifically about the high-end office buildings doing really well and outperforming. But what we're facing today is an interesting thing. This isn't really a structural problem with commercial real estate. In other words, it's not necessarily an oversupply issue. It's not really an over-leverage issue. It's really a capital structure problem where rates ran up so quickly and people have been caught. No one was expecting to pay 8% interest. And buying at a 3 or 4 cap or a 5 cap would imply that you can't borrow at 8.
Right. Correct.
You got to come back.
I feel like we could do,
Told you we love talking
this.
real estate.
We do love talking. Hopefully you'll come back.
I'm happy to come back.
We would love it. Warren de Haan, he's Chief Executive Officer of Acore. I think I said it incorrectly to begin with, but joining us here in our Bloomberg Interactive Broker Studio.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
You drive me crazy.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
Can you believe it, Carol? It's that time?
Which part?
It's that time.
I know.
Time flies when you're having fun.
Time flies when you are having fun. I always have fun.
You got a
around here.
big week.
I have a big week. I'm jumping on a plane tomorrow, but I'll be here tomorrow.
You're leaving me and my show.
Going to Nashville, baby.
Our show.
Got a new song. I'm going to take it to the
Okay.
old Opry or
You're
whatever.
basically there for 24 hours,
Not
if
even.
that.
The airline
Then you're coming
crew's
back
going to
here.
know me. Yes,
Yes,
I'll be
it
back.
might be the same plane when you come back.
We have done that before.
We have done that.
Someday Tim and I are going to write a story about our less than 24 hours in Vegas because it was crazy.
Don't go to Vegas for that. Don't fly that far for such a short time. That's what I'll say. Hey, interesting market moves today also.
Yeah, some volatility as Abigail was talking about coming back into the market, and also, just some crazy trades. It wasn't just the meme stocks, but also we're still trying to figure out what happened with some names like Chipotle, Berkshire, Abbott Labs. It's a wacky Monday.
Yeah, and commodities under pressure. The price of oil tumbling following OPEC Plus unexpectedly rolling out a plan to restore some production to the market this year. What does it all mean? Let's get to Adrianne Yamaki, founder and financial advisor at Strategic Wealth Capital. Based in San Francisco, the firm really has a specialty in high net worth individuals, portfolio assets above $5 million. Adrianne joins us from the Bay Area. How are you?
Hey, good. How are you guys doing?
Good. It's good to have you back with us. I know you were on with us just a few months ago. I'm wondering about the questions that you're getting right now. It's something that we've been asking a lot of our markets guests as we've seen the markets move over the last 6 weeks or so. What are the questions that you're getting from your clients right now?
Most of the questions, as you can imagine, are about what's going on with the election, and it's one of the most emotional elections that I can remember, especially from the standpoint of there are a lot of legal implications, socio-economic implications, and it's something that clients, because we look at the polls every week, depending what you look at, but it looks fairly close, and the economic platforms they're each campaigning on are so different. Clients are, quite honestly, really nervous, economically, and also from a standpoint of what does this mean for legal decision making around, you can imagine a lot of the socioeconomic topics that are being discussed. So that's definitely the first, number one.
Well, so having said that, if someone says, listen, Adrianne, I'm wondering, do I need to start adjusting my portfolio because of what we think might potentially happen, come November, or maybe I just want to play it safe and whatever the outcome, I'm just somewhere where I can ride it out for a little bit until we kind of see how the dust settles. I don't know. What do you tell them?
That is such a good question, because that's exactly the sentiment that people are having, which is essentially, what does a sideline look like? The election cycle is so fraught. We're tired about hearing about convictions and potential convictions and trade and what it means. Can we just sit out and wait and see what happens? Really good question.
Yeah, park it in a 2-year and get like almost 5%, right? Like, why not?
Okay, why not? I'll say why not. And I'm not giving financial advice here, but the track record for timing the market, just in general, for normal people, has not been good. I'd be hard pressed to find any person who manages money saying, you should ever try to time the market. The whole idea is time in the market, not time the market. No?
100%. Exactly, Tim. That's exactly right. Very well said. And it's funny because I think intellectually, often clients know this, but they feel like anytime something is unknown, that's what effectively plays out in risk. That's what risk is. People want to be to separate from it. So in this case, they separate from, they think of the stock market and to some extent the debt markets. But just like Carol said, can you just sit on the sidelines? The thing is, in reality, there is no sideline. There is no completely neutral, we're buffered from everything. The closest would be, say, putting it in a short-term treasury bill. And treasuries are still yielding a lot. The problem with thinking, so that's its own deliberate decision. So instead of saying sideline, we say, why don't we just sell what we have and put it in cash? And of course, just like Tim is saying, you can't time anything. So the danger of doing that, it's correct that if it's in cash, the upside is what the maturity of the treasury or the CD is. The problem is, if we look historically at what has happened after elections, it has very little, especially the first 12 months, it has very little bearing with whether it's Democrat or Republican and the specific candidate. It has very little bearing. In fact, so little as to not be something to make large financial decisions on, such as asset allocation, very little to do with how the market performs. So if we look at, for example, the last two elections, there's fascinating research that shows deep red, deep blue parts of the country, how they record their sentiment and what they plan to do for spending, career decisions, home buying. And if we look at the actual data underlying the decisions in those communities, they're completely at odds with what people feel they want. They're how optimistic they feel about the country based on the candidate who won. So we can say, if this party wins, I'm going to do this. I want to go to Canada. I'm going to stop spending. But the actual spending and consumer behavior doesn't change.
Well, like if you have to buy a house, you have to buy a car, you have to do this, like you're just going to do it, right? No matter what. Having said that, all right. And I guess the one thing I would argue is that maybe I'm not talking about timing the market, but capital preservation is an investment strategy as well. So holding on to your principal, even if it's for a little bit, can be an important strategy so that you don't lose some ground. All right, so elections having little bearing, maybe at least the first 12 months or so when it comes to maybe the investment arena. Fed policy, though, can certainly impact things.
Yep.
Got a Fed meeting next week. How are you thinking about that and the impact it might have on someone's portfolio right now? Just got about a minute left.
Yep, I think that's the right question. So last year, the deficit was about 1.7 trillion, so over 6% of GDP. So this is 100%. I'm glad you asked that. This is what I would focus on, which is whether or not the next, so it takes a long path from candidate campaign promises to who's elected, and then to what happens in Congress. So the thing that we're all thinking of is, are the tax cuts going to be extended? If they're not extended and they sunset in a year and a half, 6 out of the top 7 brackets go up. The long-term trend and the macro trend is that taxes are going to have to be higher, whether it's the next president, the next term in the future. The deficit, it's what it is, and it's an unstoppable force, economic force that's going to drive everything longer term. And that is the biggest, for my clients who are fortunate and lucky enough to have saved, taxes are going to be the biggest issue. And I'd focus in the next year and a half on what can you do to save on the taxes.
I think it makes sense. I think the political will to raise taxes, though, is really tough to find.
Not a good one, that's for sure. Adrianne, thank you so much. Adrianne Yamaki, founder and financial advisor at Strategic Wealth Capital, joining us right now from San Francisco.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.